This is FRM Part 2, Book 4, Liquidity and Treasury Risk Measurement and Management, and the chapter on monitoring liquidity. This is another chapter that's taken directly out of a textbook. And the chapter begins with an explanation of the taxonomy of liquidity. Of course, we're trying to classify, and the authors tell us that they're going to classify liquidity based on two dimensions, timing and amount. And so just imagine financial institutions, they have cash flows coming in and out in different amounts and cash flows coming in and out at different time intervals. And so this is a chapter in which we're not only going to try to monitor the liquidity, but also offer, some suggestions for managing the liquidity. This goes back to what I say to you guys, identify, quantify, and manage all of the risks. So we're inside of that, kind of that second level there. But before I look at the learning objectives for you, I want to give you just a quick example that my wife and I go through, and I'm guessing that your families do this as well. We share lots of duties in the household, but we share going to the food store. And so we're at the food store, once or twice or 3 or 4 times a week. All right, so that's, let's say 3 times a week. And we spend $20 or $60 or $200. So they're varying time intervals and varying amounts that we spend. So the food store then looks at us as a couple, and they can, try to predict, when is this couple going to show up and how much are they going to spend? And so the same thing applies here inside of the financial institutions. Of course, the final personal conclusion that I'll make to you, I wonder if you guys have the same experience. No matter how many times we go to the food store, no matter how much money we spend, my children open up the refrigerator and say, "We have no food in this house." I'm not sure what that has to do with liquidity management, but there's something in there that can be said. All right, look at these learning objectives here. We'll first talk about the difference between deterministic and stochastic cash flows. I'm guessing that you remember that difference from way back in previous recordings. We'll take a look at some liquidity options, and I'm guessing as you read this learning objective, some of you might think, "Oh, let's go ahead and get out our Black-Scholes-Merton option pricing model," but it's not quite rising to the level of needing a complex model like Black-Scholes. But we'll go ahead and talk about liquidity options. Then we'll have some definitions that I'm guessing are fairly standard. Then we'll talk about term structure, and this is probably the most important part of the chapter. So let's get started on the difference between deterministic and stochastic cash flows. And like I always try to do, let me give you just a simple example. Let's go back to kindergarten, and let's suppose your kindergarten teacher put out 4 apples in a row. And your kindergarten teacher got out a nice thin cloth and covered up 2 of those apples and said to you, "How many apples are in total?" And you could count the 2 that you can see, and then you could count the 2 that have bumps in the towel, and you would say, "Oh, there are 4." And no matter how many apples that were underneath there, you could look at the visual apples, and you could look at the apples that were covered, but you could see their humps. So no matter what your teacher did, this is a deterministic model. The model tells you exactly what the outcome is. I can see 2 and 2 are hidden, or I can see 1 and 3 are hidden. But for stochastic, let's go ahead and instead of apples, let's suppose we have a ping pong machine like they do in lottery games. And let's suppose there are 1 million ping pong balls in this machine, and you hit the lever and a bunch of them fall on the table, and your kindergarten teacher covers up some of those and leaves some of them visually and says, "All right, now what?" And let's make it even more complex. Let's suppose that, what did I say, there were 1 million balls. Let's suppose that 200,000 of those were marked with red dots. And so your kindergarten teacher says, "Okay, how many under the towel are red dotted?" And, you just kind of throw up your hands and say, as a kindergarten, and even as a 59-year-old adult like I am, you just say, I have no idea. And so that's pretty much the difference between deterministic and stochastic cash flows, or this idea as it goes back to your days in statistics. With deterministic, you pretty much know what's going to happen. With stochastic, it's just the opposite. You kind of have no idea what's going to happen. I mean, think of all those ping pong balls there. You have no idea how many of them are red and how many of them are clear. But remember, statisticians, then they take samples and they start collecting these things, and then they get a mean value, and then they get a standard deviation, and then maybe a third moment of the distribution, and the fourth moment of a distribution. You guys should remember what those are called: skewness and kurtosis. So when you have those 4 moments of the distribution, then you take those stochastic random variables and you kind of get a sense of what's going on. So you start out with stochastic random variables, you have no idea, and then you lump them all together and you start figuring stuff out. So you can manage deterministic and you can manage stochastic cash flows. All right, so here we go. This is what I was saying to you at the very beginning: classifications based on time and classifications based on amount. And look at the bottom illustration we have there. So in the black, uncertainty for stochastic, certainty for deterministic. Boy, I'd like for you guys to think, okay, stochastic, we have no idea what's going to happen, but then we have all of these statistical and econometric tools to help us manage that uncertainty so that we can feel comfortable with stochastic cash flows and stochastic random variables. All right, so is there anything important that I missed going over those slides? Okay, so based on time, deterministic cash flow occur at future instants that are predictable, right? So if you buy a bond, you know that you're going to get those coupon payments every 6 months, right? Classification based on amount, often related to fixed financial contracts. There's a fixed loan. How about subcategories of stochastic cash flows? All right, credit related. So this has to do with credit events, which are, the obvious notion is default. Another obvious notion is a credit downgrade or upgrade. Indexed or contingent. Think of a plain vanilla interest rate swap. So that amount of those cash flows depends on some market variable like the London Interbank Offered Rate, or maybe if it's an equity swap, maybe the return on the S&P 500 index, or if it's a currency swap, maybe that's the rate between the US dollar and the euro. How about behavioral stochastic cash flows? I'm always fascinated by the linkage and the marriage between, other disciplines and economics and finance. And so this behavioral finance really started to gain traction in the late 1980s, probably the early 1990s, that individuals are affected by their own individual behavioral tendencies. Now, there are behavioral problems, there are cognitive errors that are in the brain, there are emotional biases that are in the soul, but these here, stochastic cash flows from the behavioral standpoint, are not that deep. And look at these examples here. The decision to pay off a mortgage is based really on the level of interest rates. Doesn't really have anything to do with my own personal preferences, although I may say, okay, if interest rates drop by 0.5%, I'm going to refinance. But somebody else might say if interest rates drop by 0.5%, I'm not interested. I need a 1% or 2%. So there are behavioral issues inside of those stochastic cash flows. And then new business. And this has to do with, remember all those business lines that we have inside of financial institutions. And so we may add a business line. We may add product lines inside of each business line. What's the example here? Overnight borrowing arrangement, depending on, how many banks are out there, how many different financial institutions are going to participate in some funding request. Liquidity options. This is a lot simpler than you might think, given our vast background in options. Gives the holder the right to receive cash or to give cash from the bank. Of course, the obvious notion here is is a regular old savings account, right? My wife and I, we have a savings account down at our bank. We almost always have around $2,000 in what we call our savings account. Sometimes it's a little bit less, sometimes it's a little bit more, but we just have that in there as kind of emergency cash. But I could go down and take that out today, and that's my option, right? Also, lines of credit. But the important thing here, look at that first block point up there. It does not involve a profit or loss implication in financial terms, but it's dependent on whether or not the result of that liquidity option pushes the financial institution into surplus or deficit in liquidity. Go ahead and take a quick peek at the block we have written down below. How does this exercising of the liquidity option impact the bank? All right, so a liquidity impact on the balance sheet, usually by the amount given, withdrawn, or repaid, but it can also have a positive or negative financial impact depending on things like spreads and interest rates and inflation. Notice those bottom, the very last part of that sentence, from the time the contract is signed to the time the option is exercised. And so remember, we've talked about this before, the longer that time period is, the greater is the chance that that option is going to be even more in the money or out of the money. Let's get to that learning objective that asks us for definitions. Liquidity risk. Risk that the bank receives smaller than expected amounts of cash flows to meet its payment obligations. So think about this liquidity risk, kind of like, not exactly, but kind of like working capital management, where, as the financial manager in the institution, you know that you're going to have all these obligations coming due, at the end of the week, at the end of 2 weeks, at the end of a month. And so you're hoping that you receive cash flows. And in an ideal world, those cash flows would be perfectly matched. That's why we call, in fixed income management, we call the matching of durations to be extremely important. So that's ideal. But of course, life never works in the ideal. And so liquidity risk is the risk that those two are not going to be the same number. Funding liquidity risk then takes it one step further. Let's suppose that we have all these obligations coming in, and let's just suppose for some reason that we have no cash flows. We have no cash flows coming in. So these obligations are due. We have no cash flows coming in. So we need to figure out how we're going to make these payments. So essentially, we're going to fund those liabilities as they come in. So look at what we have here. Funds expected from clients. Sales of assets, boy, do we ever want to sell the assets? That's a conversation for a different day, or from other liquidity sources. Market liquidity risk. I learned this way back in my undergraduate days. I actually learned this in a marketing class where I learned that, a business has these assets, and if it wants to sell them, then it has to sell them in a timely manner, and it doesn't have to take a steep discount. So look at what we have written down there. Market liquidity risk, the bank's inability to sell assets, such as a bond, at a fair price with immediacy. So liquidity has these two concepts behind them. Immediacy, right? You want to sell these assets because you have these liabilities coming due. You want to sell them quickly, but you don't want to take a haircut, right? You don't want to have a $100 asset and someone said, "Oh yeah, I know you have that bill due. I'll pay you $50 for it." Of course, we don't want to do that. Funding cost risk, of course, is related to funding liquidity risk in the sense that we have to deal with spreads. All right, so a higher than expected cost in order to secure financing. And let's just say that it's the spread over the risk-free rate, or perhaps it could be the spread over some benchmark if we're not, this gigantic bank holding company. Now, moving along to include some extra definitions. These things here, notice they all have risk in there. So these are all types of liquidity risk. And a great exam question, would be to craft a question stem that describes one of these things and then says, okay, which one of the following have we described? So there are 4 really good questions based on that slide. But then let's take it a step further and define this concept of liquidity generation capacity. So think about what that means. Liquidity generation capacity. I always try to think of capacity and ability. They're not exactly the same words, but the capacity to do something. So look at that first block point there. The ability of a bank to generate positive cash flows beyond those that we know we're receiving because of contracts from the sources of liquidity available in the balance sheet. Of course, in the balance sheet, that's the obvious one, but then off the balance sheet as well. So we have balance sheet expansion and we have balance sheet shrinkage. Now, I'm guessing the authors, when they use that term, were not talking about the episode of Seinfeld where George goes into the swimming pool. All right, how about expected liquidity? This goes back to what we were talking about at the very beginning of the difference between deterministic and stochastic. So look at expected liquidity as a measure used to check whether a financial institution can cover negative cumulative cash flows at any time in the future. So what we expect to happen in the future, this expected liquidity, whatever those sources of liquidity are, is probably an average of all of those possibilities. And then, of course, we couldn't be good financial risk managers if we didn't do something that's called value at risk or cash flow at risk. So look at this block point. I love this. It's a measure of the degree of vulnerability of an institution's future liabilities and assets to the possible market variations. Look at the last circle point. Can cause future cash flows to fall short of expectations. So, this is really a value at risk and then a cash flow at risk kind of a conversation, which we're all familiar with. All right, let's move to that learning objective regarding term structure. And so what I want to do here is just take a brief moment just to remind you about term structure. Of course, we're used to the term structure of interest rates, where on the horizontal axis, we just have time. So we go from time period today and then a 1-month treasury bill all the way out to a 30-year treasury bill if we're talking about the term structure of treasury interest rates, right? And then on the vertical axis, we just have yield to maturity. So term structure always, no matter what context it's used in, has some measure of time on the horizontal axis and then some other relevant measure on the vertical axis. And we know with the term structure of interest rates, that yield curve is probably going to be upward sloping if we expect the economy to expand. And so that gives us a great sense of what interest rates are going to be. And term structure can be applied to almost anything. You guys know I like to give sports analogies. Let's suppose we're golf fans and we want to do a term structure of PGA Tour wins. And on the horizontal axis, we put number of years of experience on the PGA Tour. So these professionals, they turned pro at 20. I think Tiger Woods was 20 or 21 when he turned pro. So start that at 0 all the way out to 50. And then on the vertical axis, let's put number of wins by somebody who has that much of experience. And so you would think this would be downward sloping because the younger guys and girls on the LPGA, they tend to win. In fact, I don't even know if ever what did I say? 0 to 30. So a 50-year-old, I'm sure a 50-year-old has won on the PGA Tour, but I can't remember who it is. Anyways, that's downward sloping. It's probably not a nice, beautiful curve like we get with the term structure of interest rates. But my point is that don't be upset or intimidated by this concept, which is called term structure of expected cash flows. It's the same thing that I'm talking about with the PGA Tour and the same thing that we know regarding the term structure of interest rates. It's just that on the vertical axis, we're putting expected cash flows there. So look at that top line. So the term structure refers to the sum of expected positive and negative cash flows ordered by the date up to the last contract with the longest maturity. So look inside of the function there. There's a CF sub E, which is expected, right? And there's a plus, and then there's a CF sub E, and then there's a minus. And there, notice that in parentheses, the function includes differences between times. So you go from time period 0 to time period 0, right? So those are all that are due today. And then as you go all further out, you go from 0 to T1 and 0 to T2 and D3 and all the way out to TK. That's the longest maturity. So that's the term structure of expected cash flows. So let's go ahead and work through some of these block points just to kind of get a sense of the relationship. If you understand this in the context of term structure of interest rates, then it makes perfect sense just applying it to cash flows. You know, sometimes there might be an unspecified expiration date, and so just remember that that flows then to the stockholders. This was not terribly emphasized inside of the chapter, at least I didn't think so. You can look at this term structure as a maturity ladder. So you think of these in terms of structural liquidity, which would be longer than 1 year, or short-term liquidity, which would be up to 1 year. So that structural liquidity, of course, is less important. Boy, I don't want to say it's not important. Of course, it's important. It's less important than short-term liquidity as we're trying to manage the solvency of the financial institutions. When the assets expire, positive cash flows accrue to the bank. Of course, when liabilities expire, then there's a negative cash outflow. So this circle point down there at the bottom is really critical as you read through this chapter and you understand the example that I'm going to go through here in just a second. Remember, we started out with that big discussion on the difference between deterministic and stochastic. So in that circle point down there, look, the quantity of the cash flows is just the notional of each contract in the assets and the liabilities. So consequently, that means that this is a deterministic model. So in this example that we're going to go through here in just a second, we're going to be able to look at the outcome and say, yes, here's our liquidity needs because we're using just the notional amount of each contract. And the reason that the authors do this is to show you the deterministic model in its simple case. Then we're going to have a slide where we relax the assumptions and we're almost back to, okay, if we assume stochastic variables, then let's just throw up our hands and say we don't have any idea what's going on. But let's not do that. Of course, let's not do that. And we'll figure out a way to manage that here in just a second. So if we go through this example, hold on, it's right here. If we go through this example, this is going to be a deterministic model. But before we do that, let me go ahead and add a letter inside of our term structure, and we're going to call this cumulated expected cash flows. And so notice the function, all we're doing is kind of summing those as we go through time. All right, so here's our example. Look at the bottom left there. We have a Chicago-based bank. Assets 200, liabilities 100, equity of 100. Now, inside of that example, let's flip back up to the top. We need to make some assumptions there. No liquidity options on the deposits. Assets have no default risk. And assets and liabilities have interest income and interest expense. All right, so very important. And in fact, the authors in the chapter emphasize this as well. This is a pretty simple example. But what it does is it illustrates, here, let me go back here. It's going to illustrate this function, and it's going to illustrate that function at its base level. And then we'll go ahead and relax some assumptions and see how life is much more complex than this example. So let's finish our assumptions on the bottom right. So we have assets worth 20 million expiring at the end of year 1, liabilities worth 30 million expiring at the end of year 2. So look, we start with 200 in assets, so we have some expiring, and we start with 100 in liabilities, and we have some of those expiring. And then we have 2 interest rates. Assets earn an interest rate of 8%, liabilities pay an interest rate of 6%. Oh, would that spread were always the case, right? All right, so let's go ahead and look at the term structure. All right, so let's start out. Value of expiring assets is 20 million, right? So what we're doing is we're going to take that interest earned on the assets throughout the year. So let's first start with the 200 million, right, times the 8. that gives 8%. That gives me 16 million. Minus the interest that we paid on our 100, right? So that's 100 million times the 0.6. So that's 6 million. So we take the 16 million and the 6 million, so that gives us 10 million, and the value of those expiring assets is 20, so we have 30 of the accumulated expected cash flows at the end of year one. At the end of year two, we start with the ending balance, right? Beginning balance, so there's the 30, so let's add the interest during the course of the year. Now remember, we started with 200, now 20 expired, so we're down to 180 times that 8%. So that's around 14, and then minus the expiring liability of the 30, and then minus the interest on that entire amount, right? So we have that entire 100 million times the 6. So if you do the math in there, you get 8.4. And so notice that's just a simple math exercise to explain this concept of the term structure. And we summed all that. We got 30 at the end of year one, and we got 8.4 at the end of year two. But now, in practice, some assumptions may have to be relaxed, of course. So cash flows will be stochastic due to their linkage with changing market variables. All right, so let's go back here, and let's suppose that some of those assets over here, so we have 200 million times 8%. Now, remember, in our assumption, we just say assets 200 million, right? And so these are just simple assets. But now let's suppose that some of these are interest rate swaps, some of these are currency swaps, some of these are futures contracts, some of these are some kind of a derivative. Maybe maybe we're a financial institution that is involved in weather-related derivatives, right? So we have all these crazy derivatives that depend on things like interest rates and hurricanes, et cetera, et cetera. So when you take that plus the interest earned on assets throughout the year, the 200 million times the 8%. Remember, we just did that, at the end of the year, but we got to do this every day during the course of the year, depending on whether interest rates are up or S&P 500 is up or weather is up, whatever it is. So you could just close your eyes and envision, that top cumulative cash flow term structure in year one is way more complex than what we've decided, what we've shown you in that example. Credit models will have to be used to model the default rate. So let's go back here. Suppose we have in our assets, we have a bunch of bonds, and they might be AAA rated bonds now, but next week they might be BBB rated bonds, and then next month they might be in default. So think about how simple it is to take the 200 times the 8% now, but if you have to model default risk in there, it gets much more complex. Then we have behavioral models. Now, in the simple example I gave you earlier, just me and my wife deciding, to go down and withdraw our $2,000. But now, boy, there are behavioral models out there that can help a financial institution determine what is the most likely time period that Jim and his wife will show up at the bank, and what is the most likely withdrawal. If this model, of course, if they really paid attention, and for $2,000, I'm guessing the bank doesn't really pay attention to our savings account. But if they really paid attention, they would know that we generally have $2,000 in there. So they could pretty much count on that, until one of us dies, maybe. How about the last one there? Additional cash flows will have to be considered to take things like, rolling over of maturities and new bond issues. So let me go back here and, think about issuing a bond. So we have interest paid 100 million times 6%. Suppose we issue a bond in there, and suppose it's a callable bond. Then we issue another bond, and it's a convertible bond. And then we issue another bond, and it's a puttable bond. And we have all these different bonds out there, all with different coupon rates, and probably different yields to maturity and different time periods. And so this becomes very complex. Now, to handle this extra complexity, we look at the term structure of liquidity generation capacity. All right, so this refers to the collection, at specific times in the future of liquidity that can be generated from various sources of liquidity. And so there's the function there. So what can we do? We can sell our assets. So that's AS, so asset sales. And then RP, that stands for secured funding. I'm not quite sure why they didn't use an SF in there, the authors, but the examples that they give are repurchase transactions. So that's why the RP. And then that USF is the unsecured funding. What you can do then is you can cumulate those, you can sum those. So look at the purple function. There is the Greek capital letter of sigma, and so you're doing this over time. So let me just review what these two functions are, right? Collection of liquidity that can be generated from various sources of liquidity. So just think about, asset sales. You got this financial institution that has all these assets, things like mortgage-backed securities, things like bonds, and things. Of course, this could include things like buildings. It doesn't have to, but it could. And then you aggregate those over time, and you get the sense of what is that liquidity generation capacity, which adds value to, here, let me go way back here. It adds value to this model. Remember, this was the simple model, but it includes things like, hey, let's make sure the model is not deterministic because that's not realistic. Let's evaluate our liquidity position based on the stochastic variables that show up in these two functions. Now, a couple of other things here. There's a term structure of expected liquidity, and this is a specific measure that determines whether an institution can cover negative cumulated cash flows at a given point in the future. So think about what that means. All possible cash flows from regular ongoing businesses, so all those different business lines and new businesses, and then whatever else we can come up with, right? Now, here's that arrow point at the bottom that I think is a great exam question. So to ensure solvency, whatever that means, what we're trying to do is make sure that we can pay our bills, whatever those bills are. We want to have a positive term structure of expected liquidity. Now, cash flow at risk is the expected maximum change in a company's future positive and negative cash flows due to variations in all the risk factors that we've talked about inside of this slide deck, but also that we've talked about in a bunch of other recordings. So we have, credit variables, we have behavioral variables, we have market variables, and those, of course, include things like what's going on the floor of the New York Stock Exchange, what's going on in the Treasury market, and then, of course, just like with value at risk, we need to pick some kind of a confidence level, right? It doesn't make a whole lot of sense to say, let's compute value at risk or cash flow at risk at the 50% level of confidence, right? 50% level of confidence, that goes back to what I said at the beginning. Let's just throw up our hands and say we don't know what's going on. That's why we go all the way up to a 95 or a 99% level of confidence when computing cash flow at risk, so that we can reach our arms way around this material, and so we feel like we can hug it, right? At 50% confidence or 25% confidence, we're way out here and not quite sure what's going on. Let's take a look at that last learning objective, and what I want to show you before I go through these last couple of slides is the answer to that question here. So term structure of available assets. It's a tool used to monitor a bank's liquidity generation capacity and to evaluate the liquidity power of every asset owned by the bank. So what I want to do here before I go through these slides is I want to show you this. Look, we're going to do repos in the first two, right? So there's a reverse and there's a repo. And then there's a buy sell back and then there's a sell buyback. So we'll do those two, and there's security borrowing and security lending. So really I want you to look at these last 6 slides as really just 3 examples. And as I go through these slides, I want to emphasize about the collateral, who owns the collateral, and in which direction is the term structure of available assets affected. All right, so let's go ahead and do this. Look at that bolded comment, that bolded question up at the top. How do various operations affect the term structure of available assets? So that's what we're trying to do here in this next series of slides. slides. So let's start with these repurchase transactions. So I know in a recent video, I've given you a really good example of a repurchase transaction and the desire on both parties to enter into this contract, which can last, remember, a day. Lots of them are for a day, but I mean, you could have a repurchase transaction for 50 years. I mean, it doesn't make a lot of sense, but two people could sit down and agree to exchange something in 50 years, right? All right, with a reverse repo, what happens is that the financial institution has some extra cash, and what it does is it lends that cash out to somebody like a hedge fund and receives collateral, like a treasury bond, right? And so what happens is that that bank can use the collateral for other transactions. Remember, we called that, rehypothecation. And so look at that arrow point. Term structure of available assets increases by the repo's nominal amount. All right, so that's important. So let me go to the next slide and let's talk about repo transactions. And so just the opposite occurs here. Bank receives cash and provides the collateral. And so the term structure of available assets decreases. I want to go back and toggle between these two slides. So this sounds to me like great exam questions, right? Here's a repo and here's a reverse repo. What happens to the TSAA? Now, here's a big difference. This is important before we get to the next pair of slides. In a reverse repo, the counterparty still owns the collateral. So those asset payments are not included, back to what we talked about at the beginning of this slide deck. And so that's an important distinction between the reverse repo and the buy and sell back transactions. So before I move on, let me go ahead and just remind you guys, look at what we have in bolded here, the arrow point, increase there, decrease there, not included, there we go. So we have all of this stuff about the impact and not impacted, and that should help you answer those questions. Now, how about a buy-sell back transaction? Here, the bank lends out cash and receives collateral, which sounds an awful lot like we talked about in the previous example, but the big difference is that the bank gains the ownership of the asset at the start of the contract. So the term structure of available assets increases by the contract's nominal amount. And so let me go here to the sell buyback transaction. And so here the TSAA decreases by the notional amount of the transaction. And then we can go to security borrowing and security lending. So here the bank takes possession of the asset. Here the bank provides the asset. So under security borrowing, the term structure of available assets increases. Under security lending, term structure of available assets decreases. And that takes us through these learning objectives for this chapter. I would say that the general sense here for an exam questions would be to ask a simple model like the 4 apples, or that simple example like we did with the 200 million in assets and the 100 million in liabilities, a simple deterministic model. That sounds like a really good exam question. And then what sounds like even better questions are examples of, if we relax one of those assumptions, how is it going to change that deterministic model? And then, of course, knowledge of term structure, as I said in the beginning of the slide deck.